Welcome to a Coleman Conversation. Pleased to have Sean Murray. Sean, thank you so much. Editor, publisher, deBanked. Is that a fair assessment?
That is correct. That's me.
I got to start with this. I love the coat, man.
Appreciate it. I have a whole closet full of wacky coats, and this is the one that I chose today.
Well, very good. Sean does a great conference. He brings brokers and lenders together, and when he walks around, he walks around in a suit with dollar signs on it, which I appreciate from both marketing and also focus. It's a gang. This is why we're here. We're here to make money, and we're also here to lend money and take care of Main Street. But let's start with you. I followed you. A great career path. You started as a merchant cash advance lender. Why don't we start there and define that? But I don't want to start there. I want to start with deBanked. I love the title. I think it says a lot. How'd you come up with that, and what was your thought process? deBanked is his month. It used to be a monthly publication. Sean, I'm gonna stop talking. Tell me about deBanked.
Sure. So deBanked really started as a blog. As you kind of alluded to, I started in the small business finance world. And the funding side as an underwriter now almost 20 years ago. I was a broker for a few years in that, doing primarily the MCA product at the time, and then started blogging as a broker. And originally the blog was actually called Merchant Processing Resource, which was not a very good name for branding. It's hard to type in. And it was very payments oriented. Right. Lending and payments were kind of overlapping. That was the big thing at the time. And then we had this whole big fintech cycle begin, where even the fintech term kind of came into existence. And I realized, wow, there's a lot more ground to cover now. The universe is a lot bigger. How can we rebrand this to reflect the different types of non-bank finance options that are out there, payments options, what would describe something sort of non-bank finance related? And lo and behold, deBanked wasn't taken, even though it was kind of a word that had been mentioned here and there. That's the domain name was available, rebranded to it, got the trademark. The blog turned into a publication. We did for a long time have an actual physical trade magazine. We published it for probably 5-6 years. COVID is what kind of made that difficult to continue on, because it was a B2B based publication when everyone was all of a sudden not in the office. The distribution channel kind of got disrupted there. So we said, let's just move it online. That's where we were seeing most of our action anyway, which is, no surprise for anyone in the media business. And we started doing conferences as well in 2018. And, here we are today.
Wow, it's a great story. Content is king in any media content information, and you've done a very good job on creating excellent content for your borrowers. But let's go back to deBanked. Give me your definition of deBanked, and why does that describe what you do?
So deBanked today really focuses on the small business finance community, whether that be fintech, whether that be more finance, kind of that whole sector. Yeah, we'll talk about other things that are related to those verticals, but that seems to be the area that we landed on mostly. We report the news, we give helpful information, and then, as you mentioned earlier, we bring brokers and lenders and funders and the ecosystem together. We have kind of found sort of a little nice niche for ourselves with the unsecured small business lenders of the world, right? So that's kind of where you and I differ in terms of who our primary audiences are. So we're working with a lot of the unsecured small business lenders, the online lenders, if you will. Certainly the MCA or revenue-based financing companies. But we have found over time that industry is sort of expanding, and there's a whole even SBA lending has fintech components to it now, and so there's a lot of overlap in what deBanked is talking about these days.
Talk about MCA. My audience is primarily SBA lenders. They certainly understand how to spell the MCA. You've started this, it's been about 20 years, so you've seen a tremendous amount of changes in the industry. Tell me Give me an MCA 101 definition in 2025. How does this product look today?
Well, 20 years ago, the way it worked is you would buy the future credit card or debit card receivables, primarily of a retail business. It has since evolved to buying all future revenues or deposits or receivables of a company, ones that they're going to generate in the future. The withholding of those future revenues tends to happen by ACH. That's the main change over the years. So I would say today the definition is still the purchase of future revenues or future receivables. It's just how they're collected is primarily an ACH debit.
I notice you don't use the term loan. Why is that?
Well, MCAs, revenue-based financing, they are not loans. They are actual true purchases if structured correctly. I know that's been an area of debate for the last few years when certain companies did not structure theirs correctly, either contractually or in practice, right? You can do it wrong. And so they're not loans if you structure them correctly and then you act accordingly, and with what the contract says. So there's no they're not repayable absolutely is kind of one of the big components to why they are not loans. They tend to not be personally guaranteed,
right? Which is
another
huge. Which is huge point.
Is another factor. And if also done correctly, there is no exact time frame in which they are repayable. There might be an estimated, anyone can create an estimate of when they think it will be completed, but there's not an absolute time frame. Whereas with a loan, you know exactly when the payment is due and when the loan is due in full.
Sean, I've branded this as a Coleman conversation, certainly, and I appreciate you coming on. So I'm not. It's a friendly conversation. So I'll ask you the difficult question in a roundabout way. Fair enough.
Sure.
SBA has come out with a new SOP saying we don't like refinancing MCA, which I find interesting because right off the bat you said, well, it's not a loan, it's a purchase of a future revenue stream. Defend the industry. If you have a seat at the table with SBA, what would your defense of a SBA lender being able to refinance an MCA lender? SBA is saying whenever we do that, those defaults, those charge-offs are off the chart. Defend your industry when you're sitting at the table with SBA.
Well, I think first and foremost is that MCAs are often confused with the cost. There's an assumption that they cost a lot, whereas really an MCA is just a structure. It's a purchase of future revenues at a cost that is to be determined by the parties involved. Sure, there are plenty of funders out there who, it's where it's a very expensive contract, but there are also some where it's not very expensive. So if I were to sit with the SBA, I'd say you kind of missed the context part of, perhaps if the structure of the agreement is too expensive for what you deem, risky, then I could understand, your hesitation there. But there are fintech providers who use a very similar structure or even the exact same structure for which the cost is actually pretty affordable and reasonable. And I don't think that they should be lumped in, with the ones that are higher cost.
That's an excellent defense, and I'm a free market guy, and the borrower. Give me a typical MCA borrower. Describe their persona.
Well, the original stereotype was a restaurant, 2-3 years in business. That was looking for 25,000. That was the MCA client that people used in the beginning. It's much more evolved now because you can typically look at any kind of business whatsoever. And I guess you could say, rather than say, it's a restaurant, or it's more of, I'd say maybe the average deal would probably be more in like the $50,000 range, and that be any kind of business at all.
And then how is it structured?
So it's just structured as a purchase of the future revenues. An upfront payment is given to the merchant or business owner today. They then take a percentage of sales, or they take a fixed amount of sales, and then they reconcile the payments at a later date. So if they agree on a fixed amount now, but the payments are actually supposed to be variable, right, in line with the sales activity, then the merchant can call up and say, look, my sales went down, and so the fixed amount doesn't reflect what I was supposed to deliver to you. Therefore, we should do a reconciliation. That's a very common clause that you'll find in any MCA revenue-based financing contract.
How does this compare with factoring? Traditional bankers, we all understand factoring. We understand that's expensive money, but we understand how that transaction works. Can you compare and contrast for me?
Well, I would say that there are certain members of the industry that would say that factoring and MCAs are essentially the exact same. Of course, you'll have numerous people in the factoring industry who says that's just not the case, right? Mm-hmm. We've seen some of the friction between the two in the past. Factoring is about receivables that already exist. You can point to them. It's an invoice or something of that nature, and say this party owes me $50,000, and I'd like to factor these existing receivables. Whereas the MCA is revenues and receivables that do not yet exist. That's really the only major difference between the two.
Sean, you were very gracious to invite me last year to one of your broker fairs. What I was fascinated by is there is a cadre of individuals who make a living broker these type of arrangements to Main Street businesses, but there were also a number of lenders, 7A lenders. Obviously, they were there, but you also have a number of lenders. Why would my audience be interested in what you're doing at these broker fairs?
So the reason being is that you have the ability, or lenders in your network have the ability to tap into a broker community that they're otherwise not tapping into. Mm-hmm. I think every segment of commercial finance has their own community that they're used to working with. They have their own conferences, they have their own trade groups, and you kind of get to know who every party is, right? And you sort of compete for the same people, and people come into your network and fall out of it, but you know who everyone is. But if you're interested in growth and looking for how do I find new brokers, new referral partners that don't require that much training, because you can always go out and train new people to sell SBA loans and stuff. And there's plenty of broker schools and things of that nature. But there can be a bit of a learning curve, and it can take a while for them to get up and running. Not to say that they don't work. They obviously work. It's very effective. But if you could tap into an existing broker network, people who are savvy at selling commercial finance products and have access to thousands, hundreds of thousands of small business owners that they're already talking to, and say, hey, what if you sold my product? It would be a good fit for them. Let me just tell you how it works, what you need to do, and put it in front of them, and let's get some of these done. Putting this product in front of a sophisticated commercial finance broker is a shortcut to getting new deals. So that's why they should be interested.
And running a small business is not for the faint of heart. From your perch, we hear about the retail apocalypse. That doesn't affect this, not too much, but with the Bed Bath & Beyonds and other retail stores that have had their issues, you're dealing with, I'm going to assume, more mom and pop shops, still the restaurants. How do you see the economy on America's Main Street for those type of businesses that need this $50,000 product?
What's interesting is that in the beginning of the year, there was a lot more uncertainty than there is now. Tariffs and the fear of tariffs definitely had everyone spooked. It had the lenders spooked, the funders spooked, it had the business owners spooked, and they said, I don't know if I should be doing anything. The news media really didn't help, alleviate anyone's fears. They were saying, everything's going to change. It's going to be horrible. And what we were seeing, both survey-wise, not our own surveys, but other surveys, and also just word of mouth, was that new originations had slowed, and it was really just renewals at the time. That seems to have subsided. I think the fear has gone down a lot. June was actually a record month for a lot of the funding companies that we talked to, that all-time records in terms of new deal originations. So it seems like a lot of the fear that was moving around has subsided. Obviously you have big retailers that are faltering, so it may just be a matter of maybe new entrepreneurs coming in, and they're having their chance, where you just have companies that have been around for a while, fading out. I guess it's to be determined at this time how it all plays out.
I appreciate that. I think that's a very honest assessment of what you see, and I appreciate you bringing up the disconnect with what sometimes we read in the headlines and what's actually happening on the street. You and I first met with, I believe, in a conference sponsored by Chris Roglieri. Ethics isn't, first of all, I'm not picking on MCAs. We're going to start with SBA lenders because Congress is saying, hey, we want to make sure we have proper ethics for lenders and for loan brokers and that. But that also trickles down through all of finance, so that's nothing new. What and you're pretty strong on this in terms of, because I've been to your events, I've heard you speak in terms of, guys, we got to do this right. Give me what you like to see, or how you want to see this industry act in a ethical manner. That's a poorly worded statement, so bail me out with a great answer.
Sure. I think ultimately what I would like to see most is just for each individual business owner to get the best suited product that they qualify for and are looking for. We have a large audience in the MCA world, no doubt about it. But obviously that product isn't appropriate for every single client that's looking for capital. And I think the best way to further legitimize that particular product itself, and also to foster the perceived ethics of the industry, is just to make sure that a client gets what they're best suited for at the end of the day. It could very well much be an MCA. I mean, look, it's hard to qualify for a lot of these loans out there, bank loans and in SBA loans and stuff. It's not easy. And the average mom and pop business owner, it's hard for, their books are not always in the best order. They're not up to date on taxes. They're not reporting profit. Not every employee is on the books.
No, you're absolutely right.
So what do you do? What do they do? There's definitely a need for that product 100%. But if they qualify for an SBA, or if equipment financing is better, or they have real estate and they could leverage that into something, it would be great if the brokers go down that path and help them get that. I think that would uplift everybody. And I definitely think it would make the industry look a lot better, knowing that, look, they're just getting the best product for whatever the customer qualifies for, and what more could you ask for in this American economy?
There you go. No, and a good loan broker will take that initial borrower, get them into the MCA, and then work with them. They have the financial expertise. Say, hey, this is what you need to do to get your house in order and to get to the next level. Access to capital is so important. That's why I go back to the deBanked name. I think you really, from a marketing case study, changing your name from Merchant Resource to deBanked was brilliant.
Thank you.
Couple things I want, Sean. I love having you on. I want to talk about a couple things before we finish. Talk to me about regulation. What's going on with regulation and merchant cash advance in 2025?
Regulation right now is entirely focused at the state level.
Okay.
We were supposed to have a big federal regulation go into effect this year. That's the CFPB Section 1071. It's the data collection rule. I would say, in my own opinion, not everyone was totally prepared to comply with that. I know that there's a bit of a grace period and when you have to comply with it, but it was supposed to go into effect, I believe, this month. And the new administration has not only hit the pause, they have put on a 1-year delay on that, but they've also said that they're going to rewrite the rules. Now, we have to keep in mind that this comes out of Dodd-Frank, this data collection rules. So these have been pending for 15 years. At this point, when I first started deBanked, we were talking about what the implications of this law are. So much has changed. Ultimately, it's about collecting data from applicants in a certain way, segregating it from your underwriters so that they don't see certain demographic information, and allowing the CFPB to have access to your applicant demographic data. And then there's a disagreement as to what they can or can't do with that data, whether or not they can bring an enforcement or a penalty, or if it's just used for surveying. But it was a very controversial thing. Now, certainly there were some funding companies that were ready to comply with it, but I think overall it's a pretty unpopular law in the commercial financing world. I know even some banks have.
Well, you're speaking to the choir here in my audience. I think if we could put up a live poll, it'd be 98% would say they're glad it's on moratorium and hopefully never to be resurrected. But that's
yeah. So aside from that, we're really looking at state by state regulation. They typically come in the form of a commercial financing disclosure law. Has sort of been the MCA focused regulations have been written under that terminology. There's been a couple states also that have actually made a revenue-based financing or sales-based financing specific law. So it's really about state by state regulations at this point. Sometimes it's just about a disclosure, a certain form, a certain format, a registering with the state, not necessarily a license, but maybe a registration, pay an annual fee, background check, something of that nature. So that's kind of where the industry is at. And then obviously there was something large recently in the state of Texas that was different from the rest of it.
Yeah, and you're seeing that obviously out in California, where California is basically saying, fine, if CFPB is not going to do something, we have the ability to regulate all lenders, and they're looking into that. Before we finish, talk briefly about technology. Over the last 15 years, 20 years, you've seen a lot of changes. You've seen the adoption of the fintech name. Where are we in 2025 over the next couple of years with AI and technology? And what I want to focus on, Sean, is how is that going to benefit both the lender and I guess we can't say borrower, but let's say the small business owner?
Yeah. Well, what's interesting about AI is that it's a legitimate, it's legitimate technology. It's not hype. Everyone is using it in some form or fashion. And AI was a buzzword maybe 10 years ago in the fintech world. But the thing is, we didn't have actual AI back then. We were more using algorithms, right? These were predictive, manually coded algorithms that did exactly what we wanted them to do. Anyone could do that. We called it AI because they were fancy algorithms. Now we have AI, which can kind of sort of act on its own volition. Not to say that it's conscious, but it can kind of do things as it sees fit, which is different than what we had in the past. So far, what we're seeing is that it is allowing lending companies to do things faster than they were before. It's fascinating that you can drop a bank statement or a contract into something like ChatGPT and just say, tell me what I need to know. Literally drag and drop the PDF file and say, tell me what I need to know. It's actually an experiment I did the other day. I said, read this referral agreement and tell me what how is it bad or how is it good? This type of technology didn't exist before, where it's never seen this agreement before, right? So there's nothing predictive, manually coded as to what it's going to do. It just does it on its own. This is tremendously helpful. It makes things a lot faster. It certainly makes the lenders faster. It makes brokers get answers quicker. It actually makes them more informed and educated. In fact, I just put out a blog post saying, if you don't have access to a lawyer right away, you can just drop it into a large language model and say, what is this contract really? What's in here that I need to be aware of? These were tools they didn't have access to before. So it definitely shakes things up. And then ultimately for the end user, the business owner, hopefully it means they get funds faster, or they end up, with something better. And to that end, they can drop a contract into an AI, right? We used to always talk about small font, legalese contracts, 15, 20 pages, what's in the fine print. And if you couldn't bring it to a lawyer, how are you to know? Even if you could read the fine print, you might not even know what the fine print meant.
And you're not going to, yeah. And I love it. You put that in, say, tell me what I need to know to run Bob's Pizza Parlor.
You can, it'll spit out answers. Obviously, it's not perfect. You should always consult with an attorney. But these are hacks that were just not available to the common person that's now widely available.
What I enjoyed what you said, and I agree with you 100%, it's making us more educated. I've read some things that say AI is, it's going to make us all dumber. Absolutely not. It's going to make us smarter, and we're going to be able to work smarter. I agree with you. And through that entire process, much more transparent. Tell me, let's finish up with this. I enjoy asking the question, how did you end up where you are? And that's an interesting answer. And you started as the broker and got into this. Tell me how you enjoy your job. Talking to you, I hear your passion, but tell me how you enjoy your job.
So my job is not all that different from what I used to do as an underwriter and as a broker. When I was an underwriter, not only was I talking to merchants, we had to do an interview call, an evaluation call with every applicant, but we also tended to be in touch with other underwriters at other companies to compare notes. So you sort of have this little network going where, Howard, what's happening over your shop, what's happening over here, and you start to kind of get in the know of what's going on beyond your little zone, your little desk. And so then being a broker was very similar in that I was talking to merchants, but also now I'm talking to a variety of funding companies and also lending companies. Yes, I did used to broker the MCA product quite frequently, but I also brokered some loans. I also brokered some factoring deals. I never did an SBA. I'll be the first one to admit it, but I got to learn a lot more, and I was in touch with a lot of different people. And doing this is not all that different, because what am I doing? I'm talking to all the same parties. But for me, a passion of mine was writing. And I always thought if there was a way to combine, the finance aspect of what I know with being able to write it down and then let other people learn from it or enjoy it, man, that would be a win. Fortunate to have found that, that spot in my life. And then conferences, getting to hang out with all the people that are in it. So that's pretty fun too.
Great answer. Thank you. Let's finish up. When's your next conference? We're going to send out the information, and we'll have it in our blog or in the YouTube channel. When's your next event, and how can lenders show up and participate?
So our next event is B2B Finance Expo. It's the same conference that you were at last year, Bob, and of course you are welcome back to return in the same capacity. If you'd like to be a speaker or moderator, we'd love to have you.
Put me down wherever you need me.
Awesome. So it's October 28th, 29th. It's at the Wynn again in Las Vegas.
Nice.
It happens to be the same week as Money 2020. It's the trailing 2 days. So if you're going to be in Vegas anyway that week and you don't want to do 4 days of Money 2020, just pop over right across the street from the Venetian to the Wynn. Come to B2B Finance Expo. If you have commercial finance or fintech, this would be the conference for you. We're trying to put together leaders in the industry, forge more deals, partnerships, and obviously get the news out there. Bob, I don't know that we talked about it, but the SBA in particular recently said, they didn't want to have SBA lenders pay off MCAs. That's kind of put a wrench in the whole process with the MCA strategy, MCA broker strategy of graduating clients to SBA lenders. I think this year is the perfect time to reassess how do we maximize getting those clients to SBA, possibly without using the MCA as a bridge, since that seems to now make it complicated. So I think if you're in the SBA lending world, being able to tap into this broker network and figuring out a way to take their clients and get them onto the SBA product without making it complicated or, violating any of the rules in between, that would be a win for everybody. We're very dialed into that broker community and try to make it as valuable for everyone that attends the conference.
I agree with 100%. That should be a lender decision. Not everyone who has an MCA agreement should or is eligible for an SBA loan, but there's certainly a percentage that employ people who need long-term financing, who need cheaper financing. SBA is a great solution. And there are successful stories of SBA borrowers who started with an MCA and have transitioned. So there are a number of people, Sean, and I know you are, and we're going to do that, that are going to encourage SBA to reconsider that position.
That would be great. I can't imagine their end goal is to not allow small business owners to get to SBA, right? I assume they want more eligible small business owners that could use SBA to get there. But using their bridge as a reason to make them ineligible there's got to be a way to fix that.
And I understand they can look at the numbers and say, whoa, and I don't know what the numbers are, but let's say 1/3 were a problem. Well, that means 2/3 were not a problem. And then let's educate the lenders or put in something so we know who that 1/3 are and say, okay, we're not going to lend to that 1/3, but we're certainly going to lend to the 2/3. That is reasonable. And the goal on this is to help small business, help people who start out, who don't know how to balance books, who are robbing Peter to pay Paul. They're starting a business. They know one thing. They know how to run the business. They have some employees, and it takes a community of financial experts to help identify and build those people up who can grow and who have the ability for greater success. Sean, this has been a great conversation. I appreciate it. And thank you for joining Coleman Conversation. We'll see you in October.
Thank you, Bob. Look forward to it.